Good morning everyone. Can you hear me? Okay. So in yesterday's lecture, we started with equity valuation. So today is lecture number 2 of equity valuation. In that, we had started the discussion to question number 21, and in question number 21 we had finished point number 1, where they said that last year dividend, that is D0, was rupees 14, and then it was expected to grow at the rate 9% per annum for the first 3 years, and after that, at the end of the third year, it was supposed to give you a P3 of 360. So generally P3 we would have calculated as D4 upon KE minus G. Yesterday I taught you P3 will be D4 upon KE minus G, but here we had not done that because they only gave you P3. So we took it. Everybody clear? 360 rupees. Now comes point number 2. Or I might want to do point number 3 first for you. They are asking you to again find the price of the share. Okay. You can see point number 3. They are asking you to find the price of the share at the end of 3 years. Okay. Which means they are asking you to find P3. Now you will say, sir, P3 is given, no, 360. Yes, it is given. But now they are saying, okay, forget it. Now you calculate if you are going to assume that growth rate will be 9%. You are understanding? So that means, do you realize that the P3, the way we calculate now, we will have to do it like that. P3 will be D4 upon KE minus G. That we will have to do. Everyone clear? So let's start. Point number. So you try, no? You already have D3 with you. Now yesterday we had done D3. From there D4 calculation is very simple. Add 9%. So in the notebooks, now just write point number 3. In the notebooks, write point number 3. And write P3 equal to D4 upon KE minus G. 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 Okay, so now figure out how to do it. D4, how do we get D4? D4 will be the earlier dividend, that is D3, 18.13, thank you, plus 9%, correct? 18.13 plus 9%, the whole upon the discounting rate given is what? 13%. 13% minus 9%. Understood now what you are doing? Generally this calculation comes as a part of a bigger question, in which now we put that asterisk star and we do the calculation. Yesterday we did. Here they are only asking you P3 like that. So what? 494.04. 494.04. All done? 494.04. Now students, read point number 2 and try on your own. Point number 2. Point number 2. Did you all understand that point number 2 is module number 1? They are asking you value of equity today. And can I say you will straight away do d1 upon ke minus g? Everybody clear? Nothing, no table, nothing required. Normal calculation, d1 upon ke minus g. Because now growth rate is constant at 9% from today only. Nothing great. Correct? Growth rate is constant 9% from today only. Why you want to do multi-step like that? Yeah, the answer is 381.5. Done? Hey, you're getting 381.5? Okay. Point 2 done. Okay, so with that we finished the discussion to question number 21. Yesterday this was pending, but because we had run out of time, we continued it today. All clear? No? Hello? Both points? Okay. So now everyone please come to question number 15. Question number 15. Very, very well made question. Question number 15. Are we ready? Now as you read it, now you might have felt, oh my God, what is this? But now once I explain, now you'll understand. See, Sewell Corporation, a manufacturer of do-it-yourself hardware and housewares, reported earnings of Euro 2.1 in 2003. Wait. Now don't write. Question what 15 na? Don't write. So see, in the year 2003, which I am considering as year 0, they already reported EPS of 2.1. It's already done, no? That is why I am calling it as year 0. Everyone clear? Okay. Now, on which it already paid dividends of 0.69. Okay. So I'll write here calculation. And I'll write here dividend per share 0.69. Everyone clear? 0.69. Now, earnings are expected to grow at the rate 15% a year from 04 to 08. Now, these are expectations, okay? So, 2004, 2005, 2006, 2007, 2008. Can I say for me, this is coming year 1, 2, 3, 4 and 5. Everybody clear? And in these years the EPS is expected to increase at the rate 15%. So 2.1 plus 15%. Correct? So I will now take here 2.1 plus 15%. I will take 2.42 here. Then I will do 2.42 plus 15%. 2.42 plus 15%. This is 2.78. Then 2.78 plus 15%. 2.78 plus 15%. And that comes to 3.20. 3.20. And then 3.20 plus 15%. 3.2 plus 15% is 3.68. 3.68 plus 15%. Okay, 3.68 plus 15% is 4.23. Story clear? Everyone done till here? Okay. Now, during these years, the dividend payout ratio is expected to remain unchanged. What dividend payout ratio? Do you realize out of 2.1 we had paid 0.69. So 0.69 divided by 2.1. This ratio, do you realize, is going to remain same? Everyone following? So students, if that ratio remains same, look at the screen. Can I say that means out of 2.42 rupees EPS, I will be paying out dividend like this. Please check. 0.69 by 2.1. That ratio is not going to change. Everyone clear? So that ratio now I will apply on 2.42. I will apply on 2.78 and so on. Am I making sense? Hello? Okay. So I will all done? Okay. So now I will take the calci. I'll do 0.69 divided by 2.1 first. I'll put it common and then I'll keep multiplying one by one. 2.42. So this is 0.8. 2.78. This is 0.91. 3.2. 1.05, 3.68, 1.21, 4.23, 1.39. All got these numbers? You're understanding what is happening now? Sure? Okay. So now that we are done with this, they are saying after 2008, EPS is expected to drop to a stable rate of 6%. Okay, which means let's say 2009. I'll take 1 year. 6th. From here the EPS is going to drop at a rate of 6%, which means the EPS now will be 4.23 plus 6%. Are you all able to understand? 4.23 plus 6%. So 4.23 plus 6%. 4.48 will now be the new EPS, 4.48, and then they are saying, and the dividend payout will increase to 65% of earnings. So whatever will be my EPS, 4.48 into 65% will be the new dividend. Everybody clear? Into 65%. So 4.48 into 65%, 2.91 will be the dividend of year 6. And do you realize from here it's going to grow at a stable rate of 6%. Now please understand mathematically that, I don't know if you understand maths, if this will grow at the rate 6% per annum and this payout is going to remain constant, then this also will grow at the rate 6% only. I hope you are able to understand. If dividends are always going to be 65% of earnings, and if earnings are going to grow at 6% every year, then automatically dividends will also grow at the rate 6% every year from their previous year. Everybody clear now? So with that, students, we understand the discussion to the cash flows and the dividends and this and that. So now what I will do is, here I will simply write as a heading, calculation of EPS and DPS. Hey, why did I stop at 2009? Because I hope you realize here onwards now I have the net now. Everyone clear? The dividends are going to grow, okay, constantly. Now next, what are they saying? They are saying the firm has a beta of 1.4 currently and is expected to have a beta of 1.1 after 2008. The market risk premium is 5.5 and the treasury bond rate is 6.25. Now this is, students, hinting towards calculation of KE using the CAPM model, risk free rate, which I will be teaching in portfolio management. Risk free rate plus market return minus IRA risk free rate into beta, that calculation is there. Now in that, now I will just tell you here, calculation of KE using CAPM. Okay, now the formula KE is equal to interest rate, which is risk free, plus market return minus interest rate, which is risk free, into beta. Now they are saying till 2008 the beta is going to be different, and after 2008 the beta is going to be different. So now I want you to listen. Can I say for the years 2004 to 2008, can I say KE will be, now the risk free rate given to you is 6.25, 6.25 plus. Now I will teach you later, students, that 5.5% given, no, that is market risk premium, which means it is not RM, it is RM minus IRF, that 5.5. Are you all there? In fact, in inter CA one sum was there like that. Market risk premium, market return and risk premium are two different things. Return is RM, but RM minus IRF is the risk premium. Okay, so 5.5 into, now what is the beta for the first 4 years? It is 1.4. So I'll write here 1.4. So I'll take the calci. I'll do 5.5 into 1.4 plus 6.25, and this comes to 13.95% for the first 5 years. And then I will write for 2009 to infinity, for the next ahead period, can I say KE will be, okay, KE, same calculations I'll do. KE is equal to 6.25 plus 5.5, just the beta from 1.4 is going to change to 1.1. So according to the question, so 1.1 into 5.5 plus 6.25, and this comes to 12.3%. So students, with that we complete the calculation of KE. Everyone clear? Now what are they asking you? They are asking you what is the expected price of the stock at end of 2008. Hey, end of 2008 meaning, can I say they are asking you P5. Everybody clear? They are asking you P5. So I'll write here point number A, calculation of price at end of 2008, that is P5. Hey, can I say P5 is equal to D6 upon KE minus G? Everybody clear? D6 upon KE minus G. D6 we already have. Last number, can you see D6? 2.91. We already have D6, year 6 dividend 2.91. So 2.91 the whole divided by KE. Now students, tell me which KE will you like to use? 13.95 or 12.3? Yeah, 12.3, because students, do you realize you are talking of the period D6 upon KE minus G. See, this is 0, this is 5, this is 6 to eternity. 6th year is 2005 and this is eternity. Everybody clear? Hello? Sixth year, sorry, sixth year is not 2005, sixth year is 2009. Hello, you can see this, sixth year is 2009. So here I am writing 2009 to eternity. Now this I have to discount and bring it back to year 5. Are you all there? I have to discount and bring it back to year 5. So of course the discounting rate of this period will be used. Now this period discounting rate is useless. I am just bringing it to year 5. Everyone, are you all able to understand? Yesterday's example, no? This one. You can see here 5 to eternity. I am simply bringing to 2887. You getting it now? So that much only part I am doing. So for that I will of course take the discounting of 2009 to eternity. Now that is 12.3%. All clear? 12.3%. So I will remove this. I will write here 12.3% minus, and as you know the growth is going to be constant at the rate 6% in that period, correct? From 2.91 onwards now it is going to grow at constant rate at 6%. So here I will take 6%. You all understood now from where I got 6%? EPS will grow at the rate 6%. So automatically DPS also will grow at the rate 6%. So this is 2.91 divided by 6.3%, and this comes to rupees 46.19. All coordinate 46.19, clear? And then they are talking about point number B. What is the value of the stock using the two-stage discount model? Which means they are asking you to find total V bracket E. Can I say total V bracket B means as of today? But for that we will have to make a table. No, hello. For that we will have to make a table. Why? Because can I say it's a multi-step growth model. 1, 2, 3, 4, 5 is one part. 6 to eternity, can I say, is clubbed in P5. All clear, no? 6 to eternity is clubbed in P5. So 1, 2, 3, 4, 5, 5 we will have to do. Am I making sense? 1, 2, 3, 4, 5, 5 we will have to do. Hello, sure, na? Understood what I am saying? Okay. So I'll write here point number B, calculation of V bracket E. Here cash inflow, discounting factor at the rate I don't know, and this will be present value. In fact, I'll put here 2 columns. Now listen, 1, 2, 3, 4, 5, 5 means 2004, 2005, 2006, 2007, 2008 and 2008. Can I say now we are talking only of these 5 years, and in these 5 years do you understand that the total discounting, the discounting rate that we will be taking is 13.95. Are you all able to understand? 13.95. So here I will take 13.95% to discount all the cash flows from 2004 to 2008 end. Everyone clear? We will bring all of them back till 2004. All done? Clear? Okay. Now tell me, year 1 cash flow, year 2 cash flow. Students, do you realize these are the cash flows here? 4, hold on. 2004, 5, 6, 7, 8. Correct? These numbers we will take and we will post them here. Correct? We'll post them here. And then do you realize year 6 to eternity? Year 6 to eternity has been clubbed and discounted at that, which means 2009 to eternity, that has been taken and has been placed at end of 2008. Everybody clear? End of 2008 or maybe beginning of 2009, something like that. Everyone clear? So I have brought it back to 2008, and that value, do you realize, is 46.19. That calculation is already done. I'll put 46.19 here. All following? Now what has happened? Can I say all the cash flows have come? Look at me. All the cash flows have come till 2008 end. Everybody clear? All cash flows have come at 2008 end. Now what you have to do? 2008, do you realize there will be 2 boxes? You remember yesterday's story? 2 bags will be there. One small bag that belongs to 2008, and the other bag which is 2009 to eternity. We have put the net and we have brought it to 2008. Everybody clear? And now students, do you realize 2004, 5, 6, 7 and 8? These 5 years only I have to discount and bring it to 2003. 2003 is year 0. Can I say for this I will not be using 12.3%. Everybody clear? We will be using fully 13.95% only, because 2004 to 2008 end is 13.95. Got it? From 2009 to 2000 eternity, we had to bring it now, that we took 12%. Everyone clear? Because at that time the discounting rate was 12. But when it comes to 2008, can I say you have to change the car? You're understanding now? Your car will change now. So I will now take, which car will change? I'm talking of the discounting factor car. You're understanding now? Discounting rate will change now. So 1 divided by 1.1395. So this is 0.878, 0.770, 0.676, 0.593, 0.521, 0.521, and that will give you value of equity. That will give you value of equity. So this is 0.8 into 0.878. This is 0.70. 0.91 into 0.77. This is again 0.70. 1.05 into 0.676. This is again 0.71. Then this is 1.21 into 0.593. This is 0.72. Then 1.39 into 0.521. This is 0.72. And then 46.19 into 0.521. This is 24.06. And this comes to 27.62. 2, 1, 3, 2 to 5, 5 and 6. Okay, so this must be around 27.61. Okay, everyone done? So that is the calculation. Anyone wants any explanation further now? Krishna, clear? What is the doubt? I do not understand. Anyone else, any doubt? Okay, so start copying from here. We are aware about everything from today only. Who told you we are not aware? We are aware today that things will change. All done? Okay. Please come to question number 9. Please come to question number 9. All your backlog is completed, no? Notes and all? All up to date. Sunday was there yesterday. I hope you did not watch IPL. You completed, no, your notes? And bond convexity. Imagine after saying so much you did not see and it comes in exam. How will you feel? IPL will come to your head. So what do you think? IPL is genuine cricket or it is fixed? Okay. You know, you understand it is fixed like that? But still you enjoy watching like that? Time pass. Okay. You were able to watch that interview? How many of you saw that interview? First 15 minutes, okay. Oh, full you saw. Wow. Thank you. Liked it? Okay, so thank you. 2 people have seen the interview. Very nice. Others? Three people saw. Wow, thank you. You 4. Wow, very nice. Thank you. You saw that, you saw now how sincere he was? All those who saw the video. Crazy, huh? You get so much motivated. You should get motivational stuff from such people rather than those who have done nothing in life and only do motivation. The classic case. You saw that mismatch between my expressions and his talk. If I wouldn't have told you, you wouldn't have understood. But now that you know, you know. All right. Bouncer means what? Gym, bar, pub bouncer. Oh God. Okay. Thank you. Please watch everyone. You will like it. Yeah, 5 months he did not step out of his house. Yes, true. That appendix operation and all, you heard all that story? Okay. Chalo, please read question number 9. Oh, you got my notes of forex and bond valuation? You got, no? Okay. Do you refer those notes? Will it be of any use? Should I send or I should not send? I'm not understanding. Because what will you do now? You already have the notebook. You just want to feel, oh, I have it, like that. Psychological warfare. Oh, you want me to send it to you so that your personal handwriting looks better, like that? What was that? you want to feel nice in life, so you make sir send his handwriting. Huh? Okay. So a share with a par value of 100. But you know now the entire notebook is not there. Huh? See, sometimes now I will show you solutions from my printed notes. You're understanding? Some points might be not there also. Huh? You're understanding some questions. Okay. A share with par value of 100 has a current market price of rupees 500. Okay. A share with par value of rupees 100 has current market price of rupees 500. What does this mean? Face value is 100 and CMP is 500. Annual dividend is 20%. Now this 20% is of course on the face value of 100, which means 20 rupees will be the dividend every year. If it was dividend yield percent, then that dividend yield is applied on market value. But normal dividend is applied on the face value. Bonus shares are expected to be issued during the 5th year at 1 for 4 held, which means if you have got 4 shares, do you realize you will get 1 share as bonus? Hey, effectively speaking, can I say if you have got 1 share, you will get 0.25 shares mathematically as bonus. Everyone clear? 1/4, no? 1/4 you are getting, correct? One shareholder intends to sell the share at the end of 8th year. Okay, so this guy is saying I will buy the share today, for 8 years I will hold it, after 8th year I will sell. This question is again made by God. They are saying price of the share is expected to be 900 at the end of 8th year. They only gave you P8. Otherwise, if they wouldn't have given P8, we would have done P8 as D9 upon KE minus G. But now that they have given P8 to us, we will use it. Okay. Dividend rate will remain same even after the bonus issue. Hey, if the dividend rate will remain same even after the bonus issue, can I say if your shares are increasing by 1/4, your dividend will also increase by 1/4 only. Everybody clear? Your dividend will go up. So required rate of return is 10%. Ignore taxation. Should the share be purchased, and if yet, yes, at what maximum price? Okay. Now wait, question number 9. See, they are asking you value of equity. Value of equity, you know, is present value of all future cash inflows, correct? Here also, na, value of equity is equal to present value of all future cash inflows. You understand? Na? We have always been doing that only. So I'll write here year cash inflow. In fact, I can just take calculation cash inflow, discounting factor I guess 10%. Someone please confirm this 10% now required return, just check. Okay, discounting factor at the rate 10% and present value. Now students listen, company is going to give dividend of how much? 20%. Now 20% on 100 means 20 rupees. Can I say every year the dividend is going to remain same? So do you realize that you will be getting 100 into 20%, that is 20 rupees every year for the next 8 years if you buy the share today. But then you realize, if I buy one share today, I will receive 20 rupees only for first 4 years. From 5th year onwards, can I say I'll get 1/4 dividend more because I will be getting 1/4 share as bonus. Everyone clear, no? So this, do you realize calculation is only from 1 to 4. From 5 to 8, look at the screen, it will be 100 plus 100 into 1 by 4. You are able to understand? Which means, do you realize that if you have one share of 100, now you will be having 1.25 shares of 100. That means your total number of shares that you will be having, you can do like this. See, if you want more clarity now, look at this. For first 4 years, I had one share of face value 100 on which 20% dividend I'll get. For next 4 years, I'll be having one share plus one share into 1 by 4. So basically, do you realize I'll be having 1.25 shares. The face value of those shares of course will be 100 and the dividend rate is not going to change. Everybody, are you able to understand now? Clear? And of course the dividends will now become 25. You don't need to even calculate anything. Just understand that 1/4 now your dividends will increase by 1/4 of 20 is 5. Okay, so it will become 25. Everyone clear? And then do you realize at the end of 8th year you will sell the share for rupees 800. Everyone clear? You will sell the share for rupees 800. They are asking you value of equity. Question over. Everyone clear? Question over. Now students, I will do 1 divided by, don't write now please, I hope nobody is writing. 1, it is 900, sorry, it is 900, okay. So I will do 1 divided by 1.1, 1, 2, 3, 4, and this comes to 3.170. Maths, your understanding, discounting factor, this is annuity factor. And then for 5, 6, 7, 8, I'll have to use M plus MRC. Your understanding? 5, 6, 7, 8. So 1 divided by 1.1, 1, 2, 3, 4. Now 5 M plus 6 M plus 7 M plus 8 M plus. 8th one I will write here 0.467 and I'll do MRC. This is 2.165. Till here clear? Now twist in the tail. Do you realize this 900 is having a problem? Sir, why? You will sell no at 900. They only gave no selling price. You will sell at 900. Yes, but do you realize that you don't have one share now? You have 1.25 shares now. Are you all able to understand? See, when you started this with one share, but we are ending not with one share. Now you got bonus in the middle. Everybody clear? Because you got bonus in the middle, do you realize you will be not selling one share, you will be selling 1.25 shares. So because of that, do you realize you will be selling the share at 1125. Everybody clear? The price I am taking as 900 only. Price is 900 only. But now I am saying you have not one share. No, you have got 1.25 shares with you. Everyone clear? So by the way, I am doing calculation to know whether I should buy one share today or not. It is about one only. But if I buy one share, I will end up with 1.25. That is the situation. Everybody clear now? Because I am going to get bonus shares. What to do now? Okay. Yes. Now till here everyone clear? Now last twist in the tail. The last twist is that shareholders are required to bear incidental expenses on the sale of shares at the rate 10% per market price. Now you consider this to be brokerage cost. You're understanding, when you buy and sell shares, brokerage you'll have to pay, unless you are on zero brokerage, just platforms like Zerodha or something like that, then you don't have to pay. But if you go to proper brokerage houses like ICICI Securities or HDFC Securities, Axis Securities, Kotak Securities, Angel Broking, all these kinds of people, if you go, then they will charge you brokerage on every sale and purchase. You're understanding? So here they are charging 10%. So if 10% they are charging, do you all understand that I will of course sell it at 1125, but the cash flow that I will get in hand will not be 1125, it will be 1012.5. Everyone clear? It will be 1012.5. This is the cash flow I will be getting in hand. Story clear till here? Now then I will take the calci. 20 into 3.17, this is 63.4. 25 into 2.165, okay, this is 54.125, which I will round off to 54.13, and then 1012.5 into 0.467, this is 472.84, okay, 472.84, and the total comes to 590.37, okay, 590.37. Everyone clear? All done? Now what is 590.37? This is, can I say, what I am ready to max pay for the share, correct? So I am going to write something here. Rupees 590.37 is what I am ready to max pay for the share, including purchase expenses. Are you all able to understand? Including purchase expense means what? Meaning, do you realize that just as when I sell the shares I have to pay brokerage, similarly when I buy the shares also I'll have to pay brokerage? No, there is an incidental expenses on both the sale as well as purchase. Everybody clear? Sale and purchase both are there. Am I making sense? Hello? Okay. So students, now listen to me carefully. Look at the screen. I'll tell you what I mean. Let's say you go around telling everyone, I am ready to maximum pay 590.37 for the share. Now if you are talking of the share alone, that means you are basically saying that I will pay 590.37 plus 10%. No, because do you realize that when I go to buy the share, I will not be allowed to buy it at 590 because I have to pay brokerage also on top of that. So 590 plus 10%, so total comes to 649. But do you realize that is wrong understanding? Because I am saying I am ready to max pay 590. Now when I am saying I am ready to max pay 590, I will not pay a single rupee above 590 for whatever reason. Everyone clear? This is the max I will pay. Because the moment I pay anything above 590, can I say I will not then get my required return of 10%. If I want 10% return, then the max I am willing to pay is the present value, that is 590.37. Including any expense, total, you are understanding, max. So then do you all understand that this 590 is what I am ready to pay including the purchase expenses? You are understanding? So I am writing here share price alone, and I am writing here share price including purchase expenses. Now students, if the share price is 100, can I say including purchase expenses are 110? Am I making sense? If the share price is 100, then including the purchase expenses it is 110. Including purchase expenses, I am willing to pay 590.37. That means I am willing to pay for the share alone how much? So it is 590.37 divided by 110 into 100, and that comes to 536.7. Therefore, we are ready to max pay rupees 536.7 for the share alone, and on top of that, if they ask me purchase expense is 10%, that also I am willing to pay. Everybody clear? Because total this will, I hope you realize, 536.7 plus 10% will come to 590.37. Everyone clear? All done. Now they are asking you, should you buy this share if the price is rupees 500? I will say, since current market price 500 less than value of equity 536.7, share is underpriced and should be purchased. Am I making sense? The one mistake you could do is to compare 500 with 590. You are understanding? 500 you can't compare with 590. Yes. Alternatively, instead of that, you can do like one option is you can do this. Second option is you can say, let us keep 590 only, and we will then compare this not with 500, but we will compare it with 550. You're understanding? Like, I go to buy, actual price of the share is 500, no, outside. But if I actually go to buy the share, I'll have to pay 550 considering purchase expenses. I am saying including purchase expense total I am ready to pay 590. In reality, including purchase expense, you have to pay only 550. Okay, buy the share. That is one way of doing it. Other way of doing it is, including purchase expense I am ready to pay 590, excluding purchase expense for the share alone I am ready to pay 536. Share alone is having a price of 500. Okay, I'll buy. Everyone clear? Either ways you will get the right answer. Right answer means right decision. Done? Okay, start copying then. Question number 9. All done? Okay, this was question number 9. Please come to question number 8. This question will take a long time. A very complicated question. All the best to me. Please read question number 8. Ready? Can we start question 8 of Mr. Sam? Okay, so what is Mr. Sam saying? Not Mr. Sam, there is a Sam Limited has just paid a dividend of 2 rupees per share. Just paid, already paid. This is D0. Everybody clear? This is D0 and is expected to grow at the rate 6% per annum. Okay, G. Now, after paying the above dividend, the board of directors declared to take up a project by retaining the next 3 annual dividends. Look at the screen. That means D1, D2 and D3. They are saying we will not give. Everyone clear? We will not give D1, D2 and D3. We will say, Arey, but you said no, it will grow at the rate 6% per annum and all. What happened? You are reducing it by 100% now. You are understanding? You are making it 0. So they are saying, sorry, what we told you now, we are deviating because we are going to pick up some new project for which we require cash. We cannot give you. Everybody clear? We cannot give you money and hence we will retain the 3 dividends. Now, it is expected that this project is of same risk as the existing projects. That's okay. The results of this project will start coming from 4th year onwards. Okay. So they are saying that 4th year dividend will be 2.5. Okay. 4th year dividend will be 2.5 and from there it will grow at the rate 7% per annum. Everyone clear? So for me, when I do the equity valuation, I will do 1, 2, 3, 3. You are understanding? I will do 1, 2, 3, 3. D3 will be, P3 will be D4 upon KE minus G. D4 to D eternity, I will club in P3. Everyone clear? D4 to D eternity, I will club in P3. All clear? Sure understanding. And I hope you realize, see, once the growth becomes constant now, you can do 1, 2, 3, 3, you can do 1, 2, 3, 4, 4, 1, 2, 3, 4, 5, 5, 5, 1, 2, 3, 4, 6, 6, 1, 2, 3, 4, 6, 7, 7. Anything you do, you will get same answer. Remember Divya's example, no, yesterday. Once G becomes constant, then you need not extend the table. But even if you do, you will always land up at rupees 50. You are understanding, no? That answer will come same only, like yesterday's example. Now, an investor has 1000 shares. Okay, this we will talk later. Now, show that the market value of the share is affected by the decision of the board, given that cost of capital is 8%. So, what I have underlined and read is part 1 of the question. What I have not underlined and not read is part 2. We will talk about part 2 later. First, let's understand part 1. So please don't write anything I'll first finish the whole question, please, then you copy. Done? Okay. So, question number 8, point number 1, calculation of impact of board's decision on share price. Okay, all right. Now, point number A, if new project is not undertaken. Okay, point number A, if new project is not undertaken. Now listen very carefully to this. If new project is not undertaken, students, which means the board does not go for the new project. If it does not go for new project, can I say then normal calculation of valuation will happen, D1 upon KE minus G. Normal growth rate is there. The D0 is how much? D0 is 2, growth rate is 6% and cost of capital is 8%. So I will say 2 plus 6%, the whole upon 8% minus 6%. You understood this calculation? Normal a perpetual growth rate of 6% and cost of capital 8%, D0 was 2, so D1 will be 2 plus 6%. So 2 plus 6% divided by 2%, and this comes to rupees 106. So the share price today, valuation could have been 106. As they say, this could have been us, but due to some reasons, which reasons? Board will not agree. So if the board does not agree, why will board not agree? Any ideas? Because they are saying we want to go for new project. So do you realize, if new project is undertaken, okay, calculation of V bracket E, I'll do year, cash inflow, DF at the rate 8%, present value, dash, oh sorry, not dash, 1, 2, 3, 3, dash, 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 and then I will say P3 is equal to D4 upon KE minus G. D4 they are saying will be 2.5 upon 8% minus, and they are saying from there the dividends will grow at the common rate of 7%. Story is clear, no? It will grow at the rate 7% common rate. So I'll take 7% here. So if we solve this, okay, this is 2.5 divided by 1%, and this comes to 250. I'll put 250 here. Discounting factor 1 divided by 1.08, 1 divided by 1.08, 1, 2, 3. I am anyways interested in the third year, 0.794, and when we calculate the present value, 250 into 0.794, this comes to 198.5, 198.5. Everyone clear? Okay. Therefore, if project is undertaken, value of equity increases from 106 to 198.5, that is by 90 rupees 92.5. Everyone clear? That is by rupees 92.5. So you might think, sir, but look at this, 3 years. See, in the first case we were assuming that the cash flows will be received every year, but here we are assuming that for first 3 years we will not get cash flow. So then in that case, how is the price increasing, sir? It should decrease, no? Because the cash flows are less. No, yes, it is because of the growth rate. I hope you are understanding. Do you realize that only 3 years it is not there, but then from 4th year to eternity, it will then grow at the rate 7% as compared to 6% in the first case. Everyone clear? That is making the whole difference. So therefore, always remember, in life, anytime for 2-3 years there is a big break, make sure that whenever it restarts, it gives you so much more that those breaks, etc., all that is also covered. You're understanding, no? It crosses. I think CA is like that only. Our course is like that only. You're putting a break to your life so that 4 to eternity will give you much more than 1 to eternity. You're understanding? New project. Anyways, so with that, students, we complete the discussion to point number 1. Which point did understand? It's okay. Ready? Now, can we start? All right. What do you think your salaries would have been if you just do BCom? Any idea? You should know all these numbers. One answer is I will not get job only. Yeah, okay, so around 25,000 we'll take average 25,000. Okay, so if you don't take up this project of doing CA, then can I say your year 1 salary will be 25,000 into 12, that is 3 lakhs. Correct? Second year, let's say it grows at the rate 5%. So what? 5% of 3 lakh is how much? 10% of 3 lakh is 30,000, 5% will be 15,000. 3 lakh 15,000 will be your salary. Again 5%, like that it will grow every year. 5%, 5%, 5%. Can I say in that situation, you are getting cash flow every year? Wow, that is better, no? I am getting cash flow every year. But then what is this question teaching us? It is teaching every year getting cash flow is not important. So so in this second case, do you realize 3 years break you are taking? 1, 2, 3. After that break is done, then 4th year onwards, fourth year onwards, what do you think your salary will be after becoming CA? Fresher. Assume no rank. 50,000 per month? No. Now that yeah, in a sense, some firms might give you 50, but in normal big corporates and all, you can get 70, 80 also. Correct? 1 lakh is little difficult, but you can still get it. People are getting, if your job interviews, academics and all, depends. So 8, 9 lakh, 10 lakh, like that per annum you will get. Whatever, the point is it is better than BCom, no? And then you tell me over the total span of 60 years or your career of how many years? 35, 40 years. 3 years will not matter, na? That's what this question is telling you. You're understanding? The total cash flow you will generate will be much more than going beyond generating cash flow every year. Achha, in that also you are doing articleship. There also you are getting something. Little you are getting, no, at least. If anyone is doing in Big 4, then I hope you are getting almost as much as what a BCom will get. First year is what, 15,000, no, in Big 4? Second year 20. Even in South India, same rates are there, 15 and 20. Okay, very nice. When it was 3 years articleship, 15, 20 and 25 they used to give. But now only 20. Yeah, even mid-sized, bigger mid-sized also are now offering good salary, good packages for articles. But then don't consider that to be good, huh? Otherwise you will stay there only. I always tell final CA students, one of the biggest dangers you can ever have is articleship. Biggest danger. Inter CA, no, there are 1,000 other dangers, friend circles and college and special friend and all that. There are a lot of distractions. Inter CA is infested with distractions and your age also is very dangerous. Final CA, even though your age is still dangerous, still the atmosphere is very serious because of articleship and classes, and you have gone through Inter CA, so you know what it takes to clear an exam. So you know about it. You know how those 18 days go, last 18 days, what stress is there, how you have to study the whole syllabus in 1.5 days. It is crazy. You know all that, and hence you have become little mild and sober in life as compared to what you were. You also know now you have grown intellectually, little bit maturity has come. But final CA, the biggest danger is articleship. I hate it. Not because of articleship as such, but because students take articleship very seriously. If they do that, gone. I'm telling you, if you take your articleship too seriously, you know what is the definition of too seriously? Trying to impress your office people and seniors. Gone. Your career is over. Because they are anyways not going to get impressed. And even if they get impressed, they will still give you 20,000 rupees only. What is the point of getting impressed? You have to complete CA course. You are understanding? Articleship is just a part. If you consider that to be the totality, you are gone, headed for disaster. You will then be a very experienced person with no money. You are understanding? Who wants that? You are getting it now? Please focus on what will give you more money, and that is your academics. Very serious. Yeah. For experience, full life is there. For academics, full life is not there. After a point of time, you will not be able to study unless you are in teaching field. If you are in normal work, now also you must have realized working with studying is so difficult. But once when age happens, little marriage and all will happen and all that will happen, then studies will not happen only. There is no chance. So please complete your academics in time. That is very important. Then you impress whoever you want to impress. I am talking professionally. But till that time, please don't go behind all this. People bunk lectures to go to office early. I don't understand why. See, sometimes during season and all late nights I understand. But otherwise, get out. You anyways don't belong there. They don't belong to you. What belongs to you will be your degree. Correct? Chartered accountant means even if you go to take a bank loan, CA, take. You go anywhere. If you have a CA degree, nobody will ask you where you did articleship from. Nobody will ask you where you did your college from, whether you even did college, whether you even did BCom. Nobody asks. You suddenly stand out in the crowd because of this degree. I have it, so I know what I am enjoying. So you please see, so many days we are together. Did you even bother to ask me where I did articleship from? No, because it doesn't matter. You see now, example I am giving you. It doesn't matter. It doesn't matter to you where I did articleship from. Similarly, it won't matter to your colleagues where you did articleship from. It will not, and even if it matters to some, they are just doing gossip. There is nothing else. Your income will not, you're getting it now? I am saying let's say you did articleship from a great organization, but you don't complete your CA. In that case, I am saying, you understand, no? Otherwise, if you have completed your CA and you have done articleship, great. Of course, that adds on. I am saying if you don't have a degree, then only articleship now will not help you. Please know it is a formality we have to complete. Don't get too carried away by the glamour and glitz in the articleship. Just stay away. Go there, do your work and come out. Don't stay there. Like washroom, you're understanding? It's a necessity of life. Complete it and get out now. You don't stay there. Your real life is outside the washroom. I know I should not compare articleship with washroom, but it's an analogy to help you understand the difference between the useful and the useless. If you start giving lot of importance to the useless, then the useful won't stay with you for long. Nature is like this only. Whatever you water, no, there only plant will grow. It is like this. The world only is made like this. So please tell your God, my full focus is on my studies, and I will want to congratulate all of you for coming live. I know it takes a lot, especially when many of your friends have given up. You also know now, when we started, the count was more. You also know, and of course they didn't stop coming because, oh, I am not understanding lectures. Otherwise that I would have come to know. They stopped coming because they stopped coming. They stopped coming because of, and major reason is articleship. So Zoom recording is one big problem. Because of this, because you know you have it, you miss it. And when you miss it, if you don't have the discipline to come live, what do you think you will have discipline to watch recorded? What is the logic now? Unless you are, unless you are a person who has purchased only recorded. You're understanding? You are saying that, okay, my mind is clear, I will do recorded lecture only. That is okay. That is like another category of students. I am saying you have a live classroom mindset, and then saying, no, I will go for recorded. No, mindset is not matching, no. You're understanding? There is a big chunk of students who watch only recorded lectures, pre-recorded. They will complete their syllabus, 100%. There is a big chunk who comes for live. But then there is a chunk who comes for live and then loses steam midway. They are the ones who suffer, you understand? Unless they are very dedicated, okay, no, every day whenever recording comes, I will start watching it. But then every day, if you have that mindset, recording come, I will watch it. That means you are dedicating 3 hours every day anyways. Then you come live, no? You have doubt, you can ask me. You getting it? Sir, does the field in which we do articleship matter? No. Unless you want to continue in the same field. You are understanding? Like, for example, you are doing DT and you want to continue DT, then it matters. But if you are doing DT and you want to go for FM, then nobody will shout at you why you did DT. You understand? It's an articleship, Baba. Nobody will take it, even nobody takes it seriously. Unless apart from the principal. Because it is his business, his or hers. They are also right, na? See, everyone is looking for their own benefit. You also look for your own benefit. It's like that. Nobody is wrong. Focus on studies, nothing else. First attempt. Till here you have reached. Don't mess up now. Big money is very near. You're understanding what I'm saying now? I hope you understand what money brings in. Those who say money doesn't bring happiness are the ones who either have lost all hope of earning money, or they have earned so much money that they have become philosophers. You're understanding? But this is a very niche category. Majority of us are middle class people like you and me only. For us, money does bring happiness. Accept it. Otherwise, you wouldn't have done CA. Correct? So, strive to be happy. Strive to earn big money. Imagine how much you can help in your home. What feeling that is to contribute to home. Eventually, after a few years, you can buy a house. All that is not possible if you are not doing this. You're understanding, no? Buying house is also so expensive. Mumbai is like out of question only. But even Bangalore, Chennai, now metro cities are expensive. Now all houses are expensive. But all these dreams you will fulfill. It all depends on the next 1.5 years. You're understanding, no? Your entire journey now depends on next 1.5 years. Make sure your 30s, 40s and 50s will not curse your current 1.5 years. What I did, that should not happen. No regrets. Please, you have got full life to enjoy. Do what you want. Go for IPL matches. Waste as much time as possible. Once you are CA, no, do what you want. Because you know your money will keep coming. But this is more critical now. Correct? And as I told you last time, whether I told you or not, I don't remember. Stop going behind unnecessary knowledge. YouTube, trading, stocks, analysis, economic times. You know, there is one big category of, not big, but there is a small category of students who are so loud that they will make you feel insignificant, backward, almost illiterate, skill-less, not updated. If you don't know how to trade in shares, if you don't know stock market, if you don't read economic times, if you don't need finance newspapers, you don't watch finance channels, I am giving you guarantee, if you don't see it, nothing will go wrong. I am telling you, focus on institute's material. If they wanted you to do all that, they would have told you in the material. You're understanding? I have seen lot of students so loud about all this, but if they have not cleared their degree, the silent ones who cleared are in much better positions. Full life is there not to do all this. I as a teacher I am telling you, don't read economic times. In all the recording I am telling you, I can sit and debate with anyone that for a CA student how important is economic times. Answer is 0. Because whatever time you are spending doing all that, you should have spent doing your studies. So you see, as a brain, it goes many branched. No success. If you dig well in 10 different places, from nowhere you will get water. You have to dig in one place only. Cricketers, they don't do, all-rounders don't succeed much in life. You just check. Very few. Otherwise, specialization, no. Dhoni is a specialist. Kohli is a specialist. Anyways, you are understanding what I am saying? Specialization. You will not say, I'll do everything. Not possible, human. Not possible. Accept it. I am not teaching all 5 subjects, no. You just close your eyes and think. Do you think I would have been half as effective as what I am in my subject if I would have spent my life teaching 5 subjects? No chance. I dug deep into one, na. That is why expertise comes, or whatever. If you feel I have expertise, that then, huh? But you're not doing everything. I know this also, that also. Then everything konjam I'll give you. You're understanding? On the surface. Like that. So like that for you, your area of work is only studies now. Don't divert. Don't divert. And I this is my kind of motivation, which is actually demotivation. I am not, you can do it, I don't talk all that. I am very practical. That is also required, 100% required. You see all that whenever you want time. But mine is always reality, that what you are not supposed to do. Because if we can cut out what you are not supposed to do, then you automatically will walk only on that path which you are supposed to do. Correct? What is left then to do? There was once, I'll just end this. There was once one very saintly person who had come to our community, and he was giving a sermon, and there were a lot of people, and there was one young boy who asked a question, and he asked a question to that saintly person, that how should I balance my prayers and spiritual life along with my studies. Like that he asked, because he wanted to do something, he wanted to do for God and all. People have religious and spiritual inclinations also. So he gave a very nice answer. He was a very old person. He gave a very nice answer. What's your age? He said, I am 20, something like that he said. He said, once you are 25 or 30 or like that, and once you are married, then you will have to balance your spiritual life, your spouse, your in-laws, your job, your financial management, your insurance, your society bills, your children, your children's medical expenses, your children's education, your rent, your EMIs if any, your car petrol maintenance, your gas bills, social circle and studies. How will you do that? You are understanding? So right now is the best time. You have nothing else. If not now, then when? You are getting it now? So I think you have understood what is to be done and what is not to be done, and you will do it. Okay? All right. Now, in this, I will now go to point number 2. A very exciting and interesting point. Listen carefully. Point number 2. Okay. An investor has 1,000 shares in SAM Limited and wants a receipt of at least 2,000 from this investment. Okay. Now, point number 2. Can I say D0 was 2? Whether you go for the new project or not, that is already done, na? Past. D0 is 2. Last year dividend. Where is it given to? First line. Dividend of 2. Okay. All right. Can I say an investor who holds 1,000 shares got rupees 2000 last year. This line you understood? 1000 shares into 2. This investor wants minimum rupees 2000. Now I'll put a 2000 on this and I will say 1000 shares into 2. That is a different 2000. Now the question is saying this investor wants minimum 2000 every year. Okay, and this is as per question. Now this is question is telling you, where is the question telling you? That he wants a receipt of at least 2000. Now this 2000 is different from last year's 2000. Everyone clear? Okay. Now students, give me any reason on the chat box why he wants 2000 every year. Don't give logical reason, give any funny reason. There must be something in his life for which he needs 2000 rupees. That they have not said. You tell me any reason. We'll take that and we'll go ahead. Give me any funny reason. He's saying I want minimum 2000 every year. Girlfriend gift expenses. Okay. Which part of this was funny? First word or full? Okay, everything. Alright. Girlfriend gift expenses. Bachelor party. Okay. So what we will do is, three people are saying girlfriend, including boys and girls also. Very nice. So I will, boy is also saying girlfriend expense, girl is also saying girlfriend expense. Okay, I don't know what to say. I will now go ahead. So, okay, so this investor has a girlfriend, for example, or has a friend. To this friend, this investor wants to give 2000 rupees gift every year. Commitment is there. For that, this investor has purchased shares. And this share, do you realize, did give him 2000 rupees last year? Correct? Can I say that this investor will sit and pray? Let the board of directors not go for a new project. Why? Because then his breakup will happen. Everybody clear, no? Do you realize that a gift he will not be able to give? Okay? So, God knows what kind of relationship this is. But anyways, I'll proceed ahead. Ready? Now, I am saying, if board does not take up new project, dividends will grow at the rate 6% per annum forever. Investor will get at least 2000 per annum. Is the story clear? So, because already last year 2000 he got, na, from there 6%, it will grow only from here. Which means, can I say his gift is taken care of? Everyone clear? But if board takes up new project, now this is a problem. Students, if the board takes up new project, investor won't receive dividends for first 3 years. Everyone, are you all able to understand? For first 3 years, the investor won't get dividends. So then what to do, students? If they are asking you a question, they are saying, show how the investor can maintain his, maintain his target receipt for the first 3 years. How will he be able to maintain everything? How will you be able to maintain? You have to keep giving gifts, no? How to now give gifts? You will say, sir, nothing to worry. I will convince her, no gift required. No, that is not an option. Hello, you have to give gift. That is compulsory. So if you want to give 2000 rupees gift, yes, the only option you have can I say is to sell the shares? Very good answer. Do you understand? The only option you have is to sell the shares, not fully but konjam. You're understanding, little by little you have to sell the share which are required to give gift. Everyone clear? So that 2000 rupees. Getting clarity? Everybody following? Okay. So here I will write. So to maintain receipt of at least 2000, investor will have to sell shares. Done. Now the question is how many shares, and everyone following now, how many shares you will have to sell. So I'll write here calculation of number of shares to be sold. Now in that, let us talk about at end of year 1. Now students, end of year 1, end of year 0 not required. Na girlfriend gift you gave already. Everybody clear? Now end of year 1 problem, end of year 2 problem, end of year 3 problem. Everybody clear na? 1, 2 and 3. So end of year 1, now I will have to sell the shares. Look at the screen. Number of shares to be sold, can I say will be rupees 2000 divided by P1. Take your time. Take your time. What is P1? P1 will be the price per share at end of year 1. I want to know how many such shares I should sell. Oh, I want to raise total 2000 rupees. No. So for 2000 rupees, how many shares? So 2000 divided by P1. So do you therefore realize that your entire focus now will be on calculation of P1? Everyone clear? Calculation of P1. So I will write here calculation of P1. Students, listen very, very, very carefully. Look at the screen. Can I say this calculation that you are doing is to find P0? Do you agree? You are finding the first calculation. The first one we did, no? First, hello, point number 1. This 198.5 was P0. Do you realize 198.5 is not the price at which you will be selling the share? Are you listening? 198.5 is today, is not today you already got dividend. No, your girlfriend gift you already gave. Next year problem is there. Students, do you understand that I want to know what will be the price at the end of year 1? Do you realize P1 will be D2 upon KE minus G? P1 will be D2 upon KE minus G. But I will not be able to do that D2 upon KE minus G. Can anyone tell me on chat box why? P1 equal to D2 upon KE minus G. I will not be able to do. The reason is, one is no dividend, very good answer. Second is, can I say growth rate is also not constant. Now you're understanding that G is, look at this. The growth rate here and the growth rate here, they're all different growth rates. Everybody, are you all able to understand? See, you can use Gordon's net only when G is constant. I hope you remember. Till the time G is not constant, till that time do you realize you'll have to make the table only. That is why I've kept this question in this module. Now everybody clear? We'll have to make the table only. So let's see if you understand what I'm doing here. When I will make table now, year 2 will be the new year 1. Year 3 will be the new year 2 and 2. Why? Because this very calculation I am doing, but after 1 year. No, I hope you're understanding. This very calculation I am doing after 1 year. So for me, when I started doing this calculation, what was year 1 will now become past year now when I start after 1 year. Everyone clear? If I am sitting today and I am saying, okay, this is going to be my year 1, this is going to be my year 2, Like that I am saying. But then I say, okay, now I will sit back and do calculations after 1 year. Hey, if you are going to be doing calculations after 1 year, then after 1 year, what you thought of as year 1 has now become year 0. What you thought of as year 2 has now become year 1. Everyone, are you all able to understand? Cash flow pattern is not going to change. So what I will do is, I will calculation of P1, I will say year cash inflow, discounting factor at the rate 8% and present value 1, 2, 2. I will say dash dash, and students, I hope you realize this 250 calculation will not change. I hope you realize, because now 250 means, do you get it now? This is now you are calculating P2 is equal to D3. Numbers are same only the P and D number is changing. Otherwise the calculation will remain same, only 250. Correct? Hello? It is like this. It is like this. I am saying this is year. Okay. There was a year 2000. This is 2001, 2002, 2003, 2003. Now in the year 2000, I am predicting that in 2003 the price will be 250. Now I am saying when I come to 2001, the price of 2003 will be 250, only prediction. Now we are continuing with the same cash flows. The cash flow expectations has not changed. No, everyone clear? The price will remain same only. Can I go ahead? Okay. So here I will write 250. Now in that I will do 1 divided by 1.08, 1, 2. That's it. So this is 0.857, 0.857. All clear? 0.857. So this is dash 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 dash. So 250 into 0.857, this will come to 214.25, 214.25. Correct? I'll go ahead. This will be rupees 2000 divided by 214.25. So 2000 divided by 214.25, this comes to 9.33 shares. Students, tell me, I will round it off to how many shares? Use your brains, understand the dynamics of your relationship and tell me 9 or 10. 10. Hey, if you sell 9, no, girlfriend will become angry. Why? Because then you will give a damaged gift. I hope you are understanding. Minimum 2000 you want. If you sell only 9 shares, then can I say you will get something less than 2000. For 2000 you have to sell 9.33. But 0.33 nobody knows, so therefore 10. Better safe than sorry, like that. Everybody clear? So to done. So at end of year 1, do you realize you will be selling 10 shares? So students, I think I have explained enough. Now I will ask you to write whole question, or no, I will not ask you to write whole question. I'll ask you to do something in rough right now. I want you to tell me that if you sell the shares at end of year 2, if you sell the shares at end of year 2, Rajarshi, yes, then how many shares you had to sell? Understood the question? Now end of year 2 also your girlfriend is there, no? So for that, another gift you will require at end of year 2. More shares you will have to sell. Take your time, don't do anything on like that like calci. Write and see, you will understand only then. Write properly. And say, okay, at end of year 2, if I want 2000, then how many shares to sell? It will be 2000 divided by P2, correct? It will be 2000 divided by P2. Now how to find P2? Think. I'll keep this in front of you if you want. And I will also write some extra information for you. This we got is P0. This we got P0. Price at end of year 1 we got as 214.25. Now price at end of year 2 should be how much? Price of end of year 2. Now I hope you realize if you are standing at end of year 2, then this will become 1 and 1 year. You are understanding, no? This 3 and 3 will become 1 and 1 year. Okay, so I will do now, listen carefully. So I will say okay, now at end of year 2, okay, number of shares to be sold will be (2,000) upon P2. Now how do I get P2? Now for me students, I will say, this is all I'll delete, and I will say if I'm standing at P2, year 2 has already come to a close. Now there is going to be only 1 year where dividends won't come. Everybody clear? There is going to be only 1 year where dividends won't come. And then second year onwards, the dividends will be, I hope you are able to understand what I am saying. Hello. So I'll write here 1. I'll put a star here. I'll put a star here. Actually, star not required. We already know the price is 250. Everyone clear? We know now it is 250. Everyone ready? So this is dash. This is 1 divided by 1.08. This is 0.926. 250 into 0.926, that is 231.5. Correct. 231.5. 231.5, 2000 divided by 231.5, 8.64. 8.64 shares rounded off to 9 shares. Everyone clear? Rounded off to 9 shares. Like that I'll have to do for end of year 3. Now see how much I am picking up. Only this much I am copying. You know why? Because end of year 3 is very simple. Can I said end of year 3, number of shares to be sold will be 2000 divided by P3, and P3 we already have, no, is 250. I hope you are able to understand. And this will come to what? 8 shares? This will come to 8 shares. All clear till here? This will come to 8 shares. Now there is something I want you to understand, because sometimes now if your mind has not completely focused, then one doubt could happen. Like for example here, okay, that sir, you are calculating P1, You are calculating P1. Now this number 214.25, that is P1, it is exactly where, sir, P1? So I hope you are clear in your minds. It is when I am talking P1, P2, P3, I am talking from year 0 point of view. Hello. From year 0 point of view. It is not P1 from end of year 1. You are understanding, no? It is not P1 from end of year 1. Meaning, like in year, I am doing calculations end of year 1. Now at end of year 1, when I sell the shares, I will sell at P1. Don't think that after 1 year for another 1 year. No, not like that. Everybody clear? I am talking after 1 year at that same time. Year 1, P1. You're getting it now? Same period. Which means this is a P1 compared to 0. You're understanding? It is not a P1 compared to year 1. I hope you're understanding. Like here, I am standing at end of year 2 and I want to know what is price at end of year 2. I am not talking of P4. I hope you're understanding. I am talking of P2 only. I am saying I am standing at end of year 2. What is the price now? Which means in one sense, at end of year 2, you are calculating P0 for year 2. You are understanding? You are calculating the price for year 2. You imagine now you sit in a time machine and you go for 2 years forward. Now if you go 2 years forward, what is P0 for you then is what I am calculating as P2. You are understanding? Sitting there, you are not talking of P2. Sitting there, you are talking of P0 only. You know, like we have station 0, station 1, station 2, station 3, like that is there. I want to know what is the price here. This is P2, correct? But this P2 is P0 now for this station. I hope you are understanding. For that station it is P0. But if you are sitting here and you are looking forward, it looks like P2. Everybody clear? That's what I am trying to explain. So therefore, just to give you that clarity, what I will do now, I will say, okay, calculation of P1, that is P0 for end of year 1. Are you understanding? P0 for end of year 1. Calculation of P2, that is P0 for end of year 2. See, listen, because I am calculating P0, that is why my future cash flow is starting from year 1, no? Some of you can think, sir, if you are calculating P2, then the future should start from year 3. Now I hope you realize this is year 3 only. It looks like year 1 because you are standing at end of year 2. Everyone clear? Done? And this P3 is there, no? P3. P3 is P0 at end of year 3. Now, I'll give you one more thing to give you more clarity. Okay? Okay. You might choose to write or ignore, it's on you. Whatever I'm writing in red. these years I have taken, no, 2000, 2001, 2002, like that, random years I have taken. Can I say this is price of the year 2000, 198.5? This is today, year 0. This P1 you got, na, P1 is price at end of year 2001. This is price at end of year 2002. And this 250 is price at end of year 2003. Everybody clear? That is 3 years forward. Now everyone full clarity is there? Sure which prices and how we have taken? Great. Now last point before I give you to copy A, B and C. Should we stop the analysis at end of year 3 for this investor, or should we check year 4 also? We should, na? He has to continue giving gifts. So point number D, at end of year 4. But good news, he need not sell share, or maybe fully he need not sell, because can I say he is now going to start getting dividends. I hope you are understanding. How much dividend he will get? Oh my God. Now two gifts you can give. You are understanding? 2.5. But then you will say, no sir, we have to check. I say, why? Because sir, now I am not left with only 1000 shares. No. Loot gaya na in 3 years. Meaning, what do I say in English? So in a sense, my money, loot gaya means actually somebody robbed me, but nobody robbed me here. But I'm just saying that my shares got depleted, no, last 3 years. So if my shares got depleted, gone away, I have to check how many shares are left. So can I say at end of year 4, dividends that I will receive will be 1000 shares minus, can I say the first year I sold off 10 shares, second year 9, third year 8. So minus 10 minus 9 minus 8. So this is what? 1000 minus 10 minus 9 1000 minus 10 minus 9 minus 8. 973 shares are left, and on each share I will receive 2.5 rupees dividend. So 973 into 2.5. Oh wow. Rupees 2432.5. Everybody clear? Rupees 2432.5. Everyone following till here? Does this guy need to sell more shares? Unless the girlfriend becomes more demanding along with inflation. No. Everybody clear? Do you realize that 2000 is bare minimum? Okay. So can I say, since this is above rupees 2000, no more shares need to be sold. Also, these shares will grow henceforth at the rate 7%. So can I say future also nothing to sell now? Everybody clear now? You are safe. All done. Marked safe during new project. Everyone clear? Understood? Okay. So with that we complete the discussion to this slightly complicated question, but I hope you understood it. Okay. Let's start writing question 8, point number 1. Krishna, I have showed it, no? 2000 more you got, no? Last. Fourth year onwards, you will get more than 2000. That is the improved income. That's it. Krishna, I did not understand anything. Full bouncer. If project is not taken, then why will shares reduce? Why? But you will not sell shares, no? If project is not undertaken, you will get your dividends every year. We are not comparing 1 and 2 year. Huh? They are just asking you. Comparison was done only for the price. Here they are asking you, if the company goes for the new project, how you will maintain your girlfriend. That's the only question. I'm sorry, how will you maintain the dividends? How will you maintain the cash flow? You're getting it 2000 rupees. Nothing else. Don't. Beyond that, improved income thereafter means beyond 2000 also you are getting. No, you are getting about 2000. You are getting 2432. That is it. That is the improved income. Nothing to do with the earlier case. Earlier case and selling shares and all, nothing to compare. Huh? Understood? No? Okay. So with that we complete question number. What was this? 8 na. Now come to question number 19. Very good question. It is actually a bond valuation question, but on purpose I have kept it in equity valuation. You will understand why. Take your time and read. Conjus. Oh my god, it is already 9 o'clock. Only half an hour left. Alright. Done? Okay. Conjus Limited issued fully convertible debentures with a face value of 100. Just 1 minute. Okay. Now, the coupon rate is 9% and interest is payable half yearly over a period of 3 years. Okay. 3 years means, can I say 6 periods? Hello? 100 into 9% means 9. 4.5 rupees. 4.5 rupees you will get every period for next 6 periods. After 3 years, each bond will be converted to 10 shares of face value 10 per share, which is expected to fetch a dividend of 1 per share every year. Presently, the yield on risk-free securities is 5%. Debenture holders need 3% more as premium, while equity shareholders will demand additional risk premium of 4. Compute the intrinsic value of these fully convertible debentures. Nothing we understood, but it's okay. Now listen carefully. Did you at least understand this? Should I change the highlighting color, or you're able to understand? You're able to see through it now? Okay. So presently the yield on the risk-free securities is 5%. Debenture holder says we want 3% more. Okay, which means, can I say the required return on debt is 8%? And equity says more 4, which means, can I say 12%? Are you all able to understand? They are wanting 12%. Additional risk premium, which means this 3% risk premium they want. Additionally, more risk premium they want. You are understanding? Which means total risk premium they are asking for is 7. I hope you are getting it. So what I will do is question number 16. 16 or 19? What is this? 19? Okay. Question number 19. KD is equal to 5% plus 3% equal to 8%. KE equal to 5% plus 3% plus 4%, which is equal to 12%. Story clear till here? So whatever equity related calculations we will do now, we will do for at the rate 12%. Whatever bond related calculations we will do, we will be doing at the rate 8%. Done? Okay. Now, listen carefully. Calculation of value of bond. Do you all remember value of bond will be present value of all future cash inflows. Agreeing everybody? Present value of future cash inflows. Year, I will not write year, can I say I will write period. Cash inflow, discounting factor at the rate 4%. That is 8 into 6 by 12, which is 4 na per period. I hope you remember. And this will be present value. Now, can I say for 6 periods the bond will give me 4.5 every period? Come on, hello. For 6 periods the bond will give me 4.5 rupees per period. At the end of 6th period, I would have loved it if they would have given redemption. But it is not a plain vanilla bond. It is a convertible bond, which means here, do you understand, you will be getting not the redemption value, but the conversion value. Everybody, are you able to understand conversion value? So I will say calculation of conversion value. Now students, can I say that conversion value will be, each bond will be converted to how many shares? Each bond will be converted to 10 shares. Correct? Each bond will be converted to 10 shares. So do you understand your conversion value will be 10 shares into the price per share? Are you able to understand? 10 shares into the price per share. Why did I write P3? You understood? Because this will be price at the end of year 3, no? Sir, 3 or 6? 3. 6 periods that was. The end of that is 3 years, no? Everybody clear? Okay. So which is equal to 10 shares into. How do I find P3? Can I say P3 will be, look at the screen, D4 upon KE minus G. D4 upon KE minus G. They are saying that after 3 years, each bond will be converted to 10 shares having face value of 10, which is expected to fetch a dividend of 1 per share. Which means, can I say we are expecting dividend per share to be 1. Everyone, are you able to understand? The whole divided by the KE that we need is 12%. So I will write here 12% and look at this. Everyone please. You understood minus 0. Why? Because 1 rupee every year you will get. No. Every year 1 means dividend is constant. A dividend is constant means growth is 0. Everyone clear? Now listen. Gordon did not say that growth rate has to be there. Gordon said growth rate should be constant. So can I say 0 is constant? Na? Hello, you are understanding? Every year it is 0. It's constant. Like one journalist 3 years ago was talking about one politician who had lost some 16, 17 elections in a row. Very famous politician. They are still trying anyways. So that journalist said, I admire this politician. I am not telling name of journalist, I am not telling name of politician. He said, I admire this politician. Look at the consistency. He is right. Why he is right? Because if consistency doesn't care for winning or losing, I hope you are able to understand. Consistency is consistency. You understood? Gordon said, I want growth rate to be constant. I hope you are getting it. I want growth rate to be constant. Is growth rate constant here? Yes, constant it is 0. So it fits. I hope you are getting it. At this point, I want to teach you something. Students, can I say that if G is 0, value of, forget this, just something new I am telling you. If G is 0, value of equity, can I say will be D1 upon KE. Come on, take your time. If G is constant, 0, same derivation I taught you yesterday, no, same I will apply, but the G will be 0, you are understanding? So then last na minus G will not come, it is so simple. Everyone clear? Okay. Now I want you to go to bond valuation, please. Nothing to do with this sum. I want to teach you something else only. You have bond valuation notebook with you? Same notebook, na, I guess. Go to bond valuation, go to the start. First module. Did you reach? Ah, Krishna, very good. You reached there, everyone? Can you see plain vanilla bond I have given, then I have given first module, then semi-annual. After semi-annual, there is this annuity bond. After annuity bond, the third kind of bond, perpetual bond, can you see please? And I have given to you one formula, and I don't know if you remember, I told you I will explain later the formula. The formula is interest upon R. Students, now I think I can explain this to you. Hey, do you understand that in a perpetual bond, it is like an equity share whose dividends are not growing? Think about it. Because interest, can I say, doesn't grow. The rate of interest amount will remain fixed every year, which means growth rate is constant. 0. Consistent. Gordon's formula can be used for that bond also, no? Then I hope you are able to understand. And therefore, everything is same except the minus G. You getting it, na? The minus G is not there because there is no growth. Now, those who remember foundation, should I continue or should I not? Those who remember foundation, you had this in mathematics. Present value of perpetual annuity is cash flow divided by I. This formula you had in foundation. See, same thing it is. Perpetual annuity. Annuity means every year same. And one inter CA student told me once, sir, in foundation one more thing we had. I said, what? And if it's in foundation means everyone must have seen it, whoever has done foundation. There was one formula like this. Present value of, you must have put it in option maybe, growing annuity is CF upon I minus G. There was this formula in foundation. It's there in ICEM module, I have seen it. So you realize we are basically doing the same thing, no? Perpetual. See, when you read this now, you realize, oh my God, that is why maths was there in foundation to help us in finance. Otherwise, you realize there is no use. Now, why is all that numbers there? Actually, there are a lot of good things in maths and stats. Very nice things are there, but we feel bored because we don't see the connect between who we are and what we are being taught. But when finance teacher will teach you maths, you will like it because you know that it is for finance. Application, it is like an automobile engineer who is learning to make motor cars is being taught how to use AC or how to manufacture AC. If only AC manufacturing is taught, he will feel bored. Unless he or she is told, hey, you know what, AC will be used in car. Then he will say, oh wow, you understand. Otherwise, independently boring, no, stats and maths. Boring in a sense, for majority, it is like, why are we doing it? Even though some of you might still like it, the question is, why are we doing it? The answer is, we are doing it because of finance. Because there is no financial management without grip on numbers. You are understanding? Without numbers, you can't do finance. You can't do your own financial planning without knowing numbers properly. Hence, maths and stats very important. But if you are going for finance field, you are understanding? Finance field, maths and stats are important, and don't now look at maths and stats like maths and stats. Look at it as maths and stats for finance. You are understanding? Institute inter CA. You are inter CA old course, no? So what inter CA was? Financial management, and next paper was economics for finance. You understand? Then students are a little interested. Okay. Only economics? No. Even though it was only economics, but the name given was very intelligent. Economics for finance. Like that, it was maths and stats for finance. You getting it? Like that it is. All right. Lot of portfolio management is left, huh, students. You will understand what I am talking. Okay. So I will now say bye bye to this. Okay. All right, students. Tell me. So this will be 10 shares into what is 1 divided by 12%, 8.33. And this, can I say, will be rupees 83.3, which means instead of getting my redemption value of 100, I am getting only 83.3. Correct? I am getting only 83.3. Discounting factor 1 divided by 1.04, 1, 2, 3, 4, 5, 6. This is 0.790, GT 5.242, 4.5 into 5.242, 23.59, 83.3 into 0.79, 65.81, MRC 89.40. This is the value of the bond. All clear? I am eagerly waiting for derivatives to start very soon. Derivatives portfolio. In finance, no, 3 big giants are there, giants. Forex, portfolio, derivatives. One giant we have successfully neutralized, Forex. Others are also there, mutual fund, equity, bonds, merger acquisition, corporate delivery. They are like of one category in terms of maybe difficulty, in terms of size. But these 3 are like big ones. Chris Gale. Okay. Please start copying question number 19. Done? Okay. So with that we finish question number, what was this? 19, na? Now students, in the notebooks give heading module number what 3 na now. Very simple module is starting now. Module number 3. 3 na, just check. Okay. Give heading CAPM and Gordon. CAPM and Gordon. CAPM and Gordon. Okay, write down. Step 1. Calculate KE using CAPM formula. Calculate KE using CAPM formula. KE is equal to IRF plus RM minus IRF into beta. Students, now that I am going to be teaching you portfolio also, if possible use these terms only. IRF risk free rate, RM market return, beta is beta. What all of this is, I will be explaining in detail in portfolio. Right now not required. Right now formula you have seen in inter also anyways. We'll take it and we'll go ahead. Step 2. Calculate V bracket E using Gordon's formula. V bracket E is equal to D1 upon K minus G. Understood what is to be done? Time pass. They will give you D1, they will give you G, they will not give you K. But they will give you IRF, RM and beta. So no problem, we will take that, we will first find KE and then we will do beta. In our book, ICEI questions I have taken and I have kept, there are 3 such questions. Can we start? 3 such questions. Question number 20 first. Everyone please come to question 20. You might have seen this in your, if you are in JKSC in Inter, of those whose videos are on, how many of you were there in JKSC in Inter? Okay, 1, 2, 3, 4, 5. Okay, alright. 6. Acha, okay. So you must have seen this question. We had put it in the textbook also. Take your time. It was not there in Inter CS syllabus, but we had put it like this only for fun. Question 20. Read it carefully. Ready? Everyone? Alright. The beta coefficient of Target Limited is 1.4. So this is the beta. The company had been maintaining 8% rate of growth in dividends and earnings. This is your G. Last dividend paid was 4 per share. This is your D0. Return on government securities is 10%. This is IRF. Return on market portfolio is 15%. This is RM. The current market price of one share is 36. This is P0. You know what is asked, na, that also they should have given, understand? Everything is there. What are we supposed to do? God knows. So they are asking you what will be the equilibrium price. Basically they are asking you V bracket E, and then they are asking you would you advise purchasing the share. That V bracket E we will compare with P0 and we'll figure out whether we should buy or not. Can we quickly do it, please? First we will do KE calculation and then we will do V bracket E calculation. Let's start. Question number 20. Hey, but KE not as per Gordon, huh? KE as per CAPM. Remember, na? So KE is equal to IRF plus RM minus IRF into beta. KE equal to IRF plus RM minus IRF into beta. 10, 15 and 1.4. So 10, 15, 1.4, 17% is KE. All done. D1 is how much? 4 plus 8%, na? KE can I say will be 17 minus 8. So the maximum you are willing to pay for this share is 48. Everyone ready? This is the answer to point number 1. This is the answer to point number 1. Now point number 2. Point number 2. In point number 2 we will say, since current market price is 36, right? Just check. So they are asking you, would you advise purchasing the share? I will say yes, because I am ready to maximum pay 48. Na, you're available only for 36. So since current market price less than V bracket E, all clear? No? Simple question. Share is underpriced and should be purchased. All ready? Now I want to give you little bit extra. Listen. Yesterday so much I taught you, in that na something I'll just share. Can I say here minimum required return KE, which is as per CAPM, is, can I say 17%? Now Gordon's KE, students, do you understand there is something called as Gordon's KE also, which I hope you realize is the IRR. It is, yesterday I taught you this, you remember, Gordon's KE is the IRR. It is the actual return from the share. Do you realize is D1 upon P0 into 100 plus G. This formula everyone remembers, na? D1 upon P0 plus G. Your D1 is 4.32, 4 plus 8%, that is 4.32. Hey, P0 I am taking 36, actual price I am taking, into 100 plus 8%. If you do know, you should get, I guess, something like 20%. Please check. 4.32 divided by 36 into 100, whatever you got, plus 8. Did you get 20? So can you see by this also you can understand that you should buy the share? How? It's there in front of you. Check. Can I say since IRR greater than minimum required return? Are you able to understand what I am saying? Since IRR greater than minimum required return, share should be purchased. See how fools we were in Inter. No, ICEI is saying there are 5 formulas to calculate KE: Gordon, CAPM, dividend yield, earnings yield, inverse of P, and then I will say if growth rate or data to calculate growth rate is given, one should do Gordon. If beta is given, one should do CAPM. This language in Inter CA is so wrong, because do you understand that there in Inter we are made to believe that okay, there is something called as KE. You can either calculate it by Gordon, you can either calculate it by CAPM. But now see, I have done by Gordon also and I have done by CAPM also, and I hope you realize both are conceptually different. I hope you are understanding. Gordon is your actual return, CAPM is your required return. Unfortunately in Inter, both are called as KE. Everyone clear? Both are called as KE. Both are different, and if Gordon's KE is more than CAPM KE, did you understand how you should buy the share? Because Gordon's KE is what you will get, CAPM KE is what you want. Am I making sense? All understood? They are not two variants of the same concept. They are two different concepts. Correct? Okay, copy this. You want to copy this? This is extra anyways. Remember this if possible for portfolio management. In portfolio, I will tell you how there are two ways of evaluating a share, and both ways I have kept in front of you in this particular question. I hope you understood. One is the price versus value route, and the other is the Gordon versus CAPM route. You're understanding? Both will give you. One is you compare actual price with theoretical value, for 36 with 48. And here other way you can compare actual return with required return, 20 with 17%. One is you compare rupees, here you are comparing percentages. I hope you were writing as I was giving you background music. Okay, so today's lecture clear. Ellarkum purnida. Artha aita, all clear. Sandeep, yes. Okay, thank you very much. Bye bye. Take care. See you tomorrow.